Fed officials point to smaller, cautious cuts. Australian consumers look through prospects for later rate cuts as confidence jumps, and there's been some falls in some New Zealand imports, pointing to underlying economic weakness. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodity Strategist Daniel Hynes looks at concerns China has been building up excessive stockpiles of key imports at the same time as domestic activity has been dropping off.
While they are restocking at the moment, the absolute levels and the levels compared to consumption certainly don't suggest that we've got a high level of inventories sitting in China at the moment. So that has important implications.
But first, in 5 and 5 with ANZ, US stocks eased slightly overnight, while US Treasury yields edged up again, the 10-year rising to 4.2% for the first time since July. That's due to firming expectations the Fed will be more cautious in future with rate cuts. ANZ economist Bansi Madhavani says a number of Fed officials have spoken in recent days, indicating caution on the path ahead.
Put together, the collective guidance from Fed speakers seem to indicate that a repeat of the September 50 basis point cut is off the table for the upcoming meeting in November, and a 25 basis point easing is very much on the cards. Markets are pricing around 22 to 23 basis points of easing for November. However, there is more caution around December outlook. Currently, markets are pricing 65% odds of the Fed cutting rates by 25 basis points in December.
The US dollar index was flat overnight. At 4 a.m. Sydney Melbourne time, the Aussie dollar was up 0.32% at 66.80 US cents, while the Kiwi was up 0.24% at 60.43 US cents. Number 2. ANZ's Roy Morgan Australia Consumer Confidence Survey finally broke through the key 85 barrier last week, jumping over 4 points to 87.5. That was a 90-week high. ANZ economist Maddie Dunk says last week's strong jobs data has led consumers to feel more financially secure.
We saw that employment was up 64,000 in September, and we've had a really strong run with employment recently. We're also seeing that the participation rate is at a record high, so more people are active, more people are working and have jobs, and all of those things are going to support how people feel about their finances and their ability to actually keep up with mortgage repayments or their rents or just those essential cost of living expenses, because we know how challenging that is right now.
Number 3. And the jump came despite that strong jobs data, causing market pricing for the RBA's first rate cut to jump from November 2024 and out into 2025.
The fact that rate cuts do seem like they are going to be something that we don't see for quite some time clearly didn't feed into consumer confidence in the same way that the labour market data did, because in some ways you can think that good news is bad news. Seeing a really strong labour market report just highlights the fact that the economy is resilient, and because of that resilience you might see that rate cuts don't begin as soon as many people expect. But when we look at consumer confidence, that strength in the labour market outweighed those concerns about rate cuts being pushed out.
Number 4. New Zealand recorded a third quarter trade deficit of $2.8 billion as goods exports fell 0.5% and imports rose 2.4%, boosted by a large government aircraft purchase. ANZ agriculture economist Susan Kilsby expects dairy will boost exports in coming months, but she says the import data pointed to underlying weakness in New Zealand's economy.
We did see in this latest month a bit of a slowdown in vehicle imports, so that's indicating that consumers are watching their pennies a little bit more and cutting back on some spending. So we've seen a drop back in the likes of vehicles, also furniture, and some of these more discretionary items, which isn't surprising given the current state of New Zealand's economy.
Number 5. Singapore releases its September inflation data today. ANZ economist Crystal Tan is expecting CPI inflation to be 1.8% for the year, down from 2.2% in August. While a large part of the drop will be base effects, Crystal says this would be the first reading below 2% since March 2021, paving the way for monetary policy easing.
The central bank kept its monetary policy settings unchanged at its meeting earlier this month. However, there were some dovish hints. The central bank now sees the risk to the inflation outlook as more balanced as compared to the quarter before. So if inflation continues to ease, as we expect, then that's going to strengthen our view that the central bank will opt to ease policy settings at its next meeting in January.
Crystal Tan there. Now, in our bonus deep dive interview, ANZ's commodities team has been looking at concerns that stockpiling of key imports by China could lead to sudden drops in import demand as domestic activity remains sluggish. Senior commodities strategist Daniel Hynes says the current stockpile levels don't seem excessive.
There's been a little bit of concern that with imports staying relatively high, that China was really not consuming a lot of these commodities due to what appeared to be subdued on the ground demand. But from our analysis, it does show that while they are restocking at the moment, those levels, the absolute levels and the levels compared to consumption, certainly don't suggest that we've got high level of inventories sitting in China at the moment. So that has important implications. I mean, it suggests that even if demand remains subdued, they will continue to import, but also once demand picks up, they will still need to tap international markets and those resources to really feed that growth in demand. So it's actually suggesting that the commodity environment can stay relatively positive, at least in terms of growth and demand for the foreseeable future.
It's quite a broad range of commodities you're looking at. So is it all the same focus for authorities in terms of what they're stockpiling?
Well, I think for them, certainly the commodities which go to some of their strategic targets or goals, and certainly energy security is one. And we understand, while numbers are hard to get, that stockpiling of oil, particularly into their strategic reserves, has been strong. But from visible stocks in coal and gas, we can see that they're continually adding to that picture as well. But then when you look at the metals, certainly, those key ones for that energy transition, being copper, nickel, aluminium, they continue to restock those with that longer term view around demand being relatively strong. So that will see, I think, those commodities remain a focus, and other ones, probably like steel and iron ore, just fall by the wayside somewhat.
So China's looking for self-sufficiency with commodities. How's that tracking? Is that really possible?
I suspect it'll be extremely difficult for them to be solely self-sufficient in the commodity mix. I mean, there are some, for example, aluminium, where they export large numbers, but China itself is not that well endowed with the underlying resources in a lot of commodity markets. Instead, they've focused on expanding their processing industry, so smelting and refining. But that means that they still require huge amounts of the raw material, and so that's why I think for them still, there's still a large reliance on the international market, particularly for raw materials to feed that industry, and obviously the parts of the economy they really are looking to develop over the next decade or so.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, October the 23rd. Catch you tomorrow with a look at whether Singapore's inflation data might allow for monetary policy easing early next year. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.